If you've been in the markets long enough, you learn something that surprises most beginners. It isn't the chart that defeats a trader. It isn't the news. It isn't even the market itself. No, sir. The real opponent sits much closer than that. The real opponent is the man looking back at you in the mirror. You see, a trader may know how to read a chart. He may recognize a breakout, understand support and resistance, even spot a trend forming before most people notice it. But none of that will help him if he cannot control himself. Markets don't punish ignorance nearly as often as they punish impatience. And impatience, well, that's a habit of the human mind. Have you ever noticed how calm you are when you are out of the market? But the moment you place a trade, your emotions begin whispering. Suddenly every tick matters. Every small move feels like a signal. You start thinking you must act, must do something, must fix the situation. But the truth is, the market does not reward activity. It rewards discipline. A man can lose a fortune simply by doing too much. Now let me tell you something that took me years to understand. The market pays you to wait. Not to think, not to predict, not to argue with it. To wait. And that's harder than it sounds, isn't it? A trader studies charts for hours. He watches candles form. He learns patterns, breakouts, consolidations, pullbacks. But when the moment arrives, when the market tests his patience, he forgets everything he studied. He jumps in too early. He exits too quickly. He doubles down on a losing idea just because he doesn't want to admit he's wrong. Tell me honestly, how many times have you seen a perfect setup forming, only to enter before confirmation? You felt the move coming, didn't you? You told yourself, if I don't get in now, I'll miss it. But the market isn't going anywhere. There will always be another opportunity. Professional traders understand something that beginners rarely accept. Missing a trade is far cheaper than forcing one. You see, a chart is a story. Price moves because money moves. Institutions accumulate, distribute, push liquidity, trap impatient traders. If you learn to read the footprints, the chart begins speaking to you. But it speaks quietly. It requires patience to hear it. And patience is a form of self-control. When price approaches resistance, you watch how it behaves. Does volume expand? Does momentum build? Or does the market hesitate, forming small candles, signaling exhaustion? If you rush that moment, you're not trading the chart anymore. You're trading your emotions. And emotions are expensive. The man who controls his emotions controls his capital. The man who cannot control himself will eventually hand his money to someone who can. That's the cold arithmetic of speculation. Now think about this for a moment. Why do traders overtrade? Why do they chase candles after a big move has already happened? Why do they ignore their stop loss just because they feel the market will turn around? It isn't lack of intelligence. Most traders are smart people. The problem is that the market tests a trader's character more than his intellect. A chart doesn't care what you believe. It doesn't care about your opinion. The market simply moves according to supply and demand. If buyers dominate, price rises. If sellers dominate, price falls. It's a simple mechanism. But the trader complicates it. He adds ego. He adds fear. He adds hope. And those three emotions can destroy a trading account faster than any bad strategy ever could. Have you ever held on to a losing trade longer than you planned? Of course you have. Every trader has done it at some point. You told yourself the chart would reverse. You found reasons to justify staying in the trade. You looked at smaller time frames hoping to see a sign that your idea was still valid. But deep down you knew something wasn't right. The chart had already told you the truth. Yet you ignored it. Why? Because controlling yourself in the market is harder than analyzing the market. You see, the mind of a trader must be trained just like an athlete trains his body. Discipline is not something you suddenly gain one morning. It is built trade by trade, decision by decision. When your system says exit, you exit. When your plan says wait, you wait. When your risk limit is reached, you step aside. Simple rules, but not easy ones. And here's something else beginners rarely understand. The biggest money in trading isn't made in constant action. It's made in the right moments. There are weeks when the market is noisy, choppy, directionless. Candles move back and forth without conviction. Breakouts fail. Trends collapse. That's the market shaking out impatient traders. During those periods, the disciplined trader reduces activity. He protects capital. He observes. Why risk money when the chart offers no clear opportunity? Ask yourself that question. Is trading supposed to be entertainment, or is it a business? Because in a real business, the goal isn't constant motion. The goal is profitable decisions. A trader who waits for high probability setups may take fewer trades, but those trades carry clarity. The chart aligns with the plan. Risk is defined. Emotion is quiet. And when the market finally trends, when volume expands and price breaks through key levels, that's when patience begins to pay. You see the structure forming. Higher highs, higher lows, momentum building. Now the chart is speaking clearly. But here's where another test appears. The trader who lacked patience earlier now faces greed. Price moves in his favor, and suddenly he begins thinking about what the profit could become. Instead of following the chart, he begins imagining the future. And imagination has ruined more traders than bad analysis ever has. Have you noticed how quickly profits disappear when you stop respecting your plan? One moment the trade is working, the next moment you're giving back gains because you refuse to follow the signals the market gave you. Self-control again. Always self-control, because the market offers opportunities every year, every month, every week. But the trader must survive long enough to capture them. Capital is ammunition. Lose it recklessly, and you cannot participate when the real opportunity arrives. That's why the first rule of speculation has never changed: protect your capital. The second rule, protect your mindset. Because once frustration enters a trader's mind, discipline begins to fade. He starts revenge trading. He increases position sizes to recover losses faster. He abandons the system he carefully built. Tell me something. Have you ever taken a trade simply because you were tired of waiting? Not because the chart confirmed your idea. Not because the trend aligned with your strategy. Just because you felt bored. That single habit has cost traders fortunes. Markets reward patience the same way nature rewards seasons. Trends take time to form. Accumulation takes time. Distribution takes time. The big moves that build wealth do not happen every hour. But when they happen, they reward the trader who kept his capital intact and his mind under control. You see, wealth in trading is not the result of one lucky trade. It's the result of consistent decisions made over many months and years. Every trade is a vote for discipline or a vote for emotion. Every decision shapes the kind of trader you become, and eventually the market recognizes the difference. Because the man who masters himself begins to see the market differently. Price stops looking random. Patterns become clearer, the noise fades, and the trader begins to realize something important about the game he chose to play. A trader's greatest enemy is not the market. It is his own impatience. Most people step into the market believing the challenge lies in predicting price. They study indicators, patterns, support and resistance, hoping to outsmart the chart. But after a while, if they stay long enough to be honest with themselves, they realize something surprising. The chart was never the real problem. The real struggle was controlling the urge to act too soon. The market moves in its own time. It does not rush because a trader is ready to trade. It does not accelerate because someone feels confident about a setup. Price unfolds according to supply and demand, and that process has its own rhythm. Yet the impatient trader tries to force the rhythm. He sees a possible breakout forming and jumps in before the level is truly broken. He spots the beginning of a trend and enters before the structure confirms it. Then, when the market pulls back, which markets often do, he panics and exits the trade. Have you ever noticed how often the market eventually moves exactly where you expected, but only after it shakes you out first? That is not bad luck. That is impatience. Impatience causes traders to enter trades before the setup is complete. A resistance level looks like it might break, so they buy early. But professional money rarely reveals its hand so quickly. The market tests levels. It pulls back. It gathers liquidity. The patient trader waits for confirmation. Strong volume, a clean break, a retest that holds. The impatient trader, however, cannot stand the waiting. He wants to be in the move before it begins. But getting in early is not the same as getting in right. There is another way impatience hurts traders. It pushes them to trade when the market offers no clear opportunity. Many charts spend long periods moving sideways, forming choppy, uncertain patterns. These periods are difficult because nothing decisive is happening. Price drifts up and down without direction. The disciplined trader sees this and waits. The impatient trader feels uncomfortable doing nothing. He begins searching for trades that aren't really there. A small move looks like the start of a breakout. A minor pullback looks like the beginning of a reversal. Suddenly he is entering trades not because the chart demands it, but because his mind cannot tolerate inactivity. And the market has a way of punishing that kind of behavior. Trading is not about being constantly involved. It is about being involved at the right moments. Those moments appear when structure aligns, when a trend forms, when support holds, when resistance finally breaks with strength. But those moments require patience to recognize. If a trader is constantly jumping in and out of the market, he often misses the very moves he was waiting for. Impatience also affects how traders manage risk. When a trade begins moving against them, the impatient trader hesitates to accept a small loss. He convinces himself the market will turn around quickly. He waits just a little longer, hoping price will return to his entry. But hope is not a trading strategy. The disciplined trader accepts small losses without hesitation. He understands that protecting capital is more important than proving a prediction correct. The impatient trader, however, fights the market. He refuses to exit when the chart invalidates his idea, and by the time he finally closes the trade, the loss has grown far larger than it needed to be. Patience in trading is not passive. It is active observation. It means watching how price behaves around important levels. It means letting the market reveal its intentions instead of guessing them. The chart leaves clues. Volume expansion, momentum shifts, failed breakouts, strong trend continuation. These signals take time to develop. The trader who rushes cannot see them clearly. And over time, the market begins to separate two kinds of participants, those who act out of impulse and those who act out of discipline. One group trades constantly, but rarely grows their capital. The other trades selectively, waiting for conditions to align before committing money. The difference between them is rarely intelligence. It is patience. Waiting for confirmation is often more profitable than predicting the move. Many traders come into the market believing their job is to forecast what price will do next. They stare at charts trying to guess where the next big move will begin. If price is near resistance, they assume it will break. If price is falling quickly, they assume a reversal must be close. The mind likes to predict because prediction feels like control. But the market doesn't reward guesses. It rewards evidence. A chart is not something you argue with. It is something you observe. Price is constantly sending signals about who is in control, buyers or sellers. The problem is that these signals rarely appear instantly. They develop slowly as the market tests levels and absorbs orders. That is why confirmation matters. Consider a resistance level that price has touched several times. Many traders look at that level and immediately decide it will break. They buy early, hoping to catch the move before it begins. But resistance exists for a reason. There are sellers there. Large players may be distributing shares or contracts, quietly unloading positions while eager buyers rush in. So what happens? Price pushes up toward resistance, stalls for a moment, and then pulls back. The early buyers become trapped. Their stop losses trigger, and price drops even further. Now ask yourself something: was the breakout idea wrong? Or was the timing wrong? The patient trader waits for confirmation. He waits for price to actually break through the level with strength. He watches for a strong candle, expanding volume, or a retest where the old resistance turns into support. That retest tells a story. It shows that buyers are willing to defend the level. That is confirmation. By waiting for the market to prove itself, the trader removes much of the guesswork. He is no longer predicting what might happen. He is responding to what the market is already showing. Have you ever noticed how often traders enter right before a false move? The market pushes slightly above resistance, and traders jump in thinking the breakout has begun. But then the price falls right back below the level. That's called a false breakout, And it exists because impatient traders rush into trades without confirmation. Large institutions understand this behavior. They know where retail traders place their stops and entries. Sometimes price briefly moves past a key level simply to trigger those orders before reversing direction. This creates liquidity for bigger players to enter positions. The trader who waits for confirmation avoids many of these traps. Instead of buying the first touch of a level, he watches how price behaves after the move. Does the breakout hold, or does it fail quickly? Does volume support the move, or does the momentum fade? These questions help reveal whether the move is genuine or temporary. The same principle applies to reversals. When price has been falling for a long time, many traders assume the bottom must be near. They begin buying simply because the chart looks cheap. But markets can remain weak longer than traders expect. Without confirmation, a supposed bottom can easily become another step in a longer downtrend. Confirmation might appear as a shift in structure, perhaps the first higher low after a long series of lower lows. It might show up as strong buying pressure near a support zone. Whatever the signal is, it tells the trader that the balance between buyers and sellers may actually be changing. Without that evidence, the trader is simply guessing. Waiting for confirmation also helps control emotions. When a trader enters too early, he often becomes anxious. Every small movement against him feels threatening. He begins questioning his decision, watching the chart obsessively, hoping the market will move in his favor. But when a trade is based on clear confirmation, confidence improves. The trader knows the market has already shown a sign of strength or weakness before he entered. The trade is aligned with actual price behavior, not just an idea. Of course, waiting for confirmation means you will not catch the exact bottom or the exact top. The move may already be underway by the time you enter. But the goal of trading is not perfection. The goal is probability. A trader who consistently waits for the market to confirm its direction may miss a few early opportunities, but he avoids many costly mistakes. Over time, those avoided mistakes make a significant difference in capital preservation. Because in speculation, surviving long enough to capture the real trends is far more valuable than trying to predict every move before it happens. And the market has a habit of humbling those who believe they must always be first. Discipline in following your trading plan protects both capital and confidence. Many traders believe the hard part of trading is building a strategy. They spend months studying charts, testing indicators, learning about risk management, and designing rules for when to enter and exit a trade. Eventually they create a system that makes sense to them. But the real test begins after the plan is finished, because a trading plan only works if the trader actually follows it. It sounds simple, yet this is where most people struggle. When a trader is calm and reviewing charts after the market closes, sticking to the plan feels easy. The rules seem logical. Risk limits seem reasonable. Everything looks clear when no money is on the line. But once a trade is open, the situation changes. Now price is moving. The chart is updating every second. Small fluctuations begin to feel important. The trader starts thinking about the profit he could make or the loss he might take. Emotions begin to enter the decision-making process, and suddenly the plan that looked so clear starts to feel negotiable. Have you ever moved a stop, lost just a little further away, because you believed the market would turn around? Most traders have done that at some point. The plan said to exit at a certain level, but when price reached that level, the trader hesitated. Instead of closing the trade, he adjusted the stop. He gave the market more room, hoping the move would reverse. Sometimes the market does reverse. But the danger is not in that single trade. The danger is in the habit it creates. Once a trader begins bending the rules of his plan, discipline slowly fades. One exception becomes two, then three, and eventually the plan is no longer guiding decisions at all. The trader is now reacting emotionally rather than acting systematically. A trading plan exists to remove that kind of emotional interference. It defines the conditions that must appear before a trade is taken. It defines how much capital is risked. It defines when to exit if the market proves the idea wrong. These rules are not there to limit the trader. They are there to protect him. because the market has a way of tempting traders into abandoning their discipline. A sudden surge in price can create excitement. A quick loss can create frustration. Both emotions encourage impulsive decisions. Without a plan, those impulses can easily take control. Consider position sizing for a moment. A trading plan usually includes rules about how much capital to risk on each trade. Perhaps 1 or 2% of the account is placed at risk. This keeps losses manageable and ensures the trader can survive a series of losing trades. But when discipline fades, traders often ignore these limits. They increase position size after a winning streak because they feel confident, or they increase size after a loss because they want to recover quickly. Neither decision comes from the trading plan. Both come from emotion, and the market is very good at punishing emotional decisions. Following a plan consistently also protects something many traders overlook: confidence. Confidence in trading does not come from a few lucky wins. It comes from knowing that every trade was executed according to a tested process. When a trader follows his rules, he understands that losses are simply part of the system. No strategy wins every trade. But if the plan has an edge over time, discipline allows that edge to play out across many trades. When the trader abandons the plan, however, every loss becomes confusing. He cannot tell whether the strategy failed or whether his own behavior caused the problem. Doubt begins to grow. Was the entry wrong? Was the exit too early? Should the stop-loss have been wider? The trader no longer trusts his process. But when discipline is strong, the situation looks very different. The trader knows exactly why he entered a trade and exactly why he exited. If the trade lost money, it simply means the market did not follow the expected path this time. The plan was still followed. And that consistency builds stability in both capital and mindset. Markets are unpredictable in the short term. Price can move unexpectedly. News can shift sentiment, and volatility can increase without warning. A trading plan cannot control these things. What it can control is the trader's behavior, and behavior is one of the few elements in trading that remains completely within a trader's power. When discipline guides decisions, the trader avoids many of the costly mistakes caused by impulse. He takes trades that meet his criteria. He avoids trades that do not. He respects his risk limits and accepts losses when necessary. Each decision reinforces the habit of discipline. Each trade becomes part of a structured process rather than a reaction to momentary emotions. Over time, this structure creates a quiet kind of stability in the trader's approach to the market. Because when the plan is followed consistently, the trader no longer needs to rely on hope, impulse, or sudden inspiration to decide what to do next. Overtrading usually comes from emotion, not from opportunity. Many traders believe that the more trades they take, the more chances they have to make money. It sounds reasonable at first. If the market is open and price is moving, why not participate as often as possible? But the market does not reward activity. It rewards judgment. A chart does not present quality opportunities every hour. In fact, many trading sessions pass with very little clarity. Price may move sideways, drifting between levels without commitment from buyers or sellers. During these periods, the market is not offering a clear message. Yet this is exactly when many traders feel the strongest urge to trade. Have you ever found yourself staring at a chart for a long time, waiting for something to happen? Eventually, the silence becomes uncomfortable. The mind begins searching for patterns, convincing itself that a small movement might be the start of something larger. That is how overtrading begins. The trader enters a position not because the setup is strong, but because he wants to feel involved. The trade provides excitement. It gives the impression of progress. But progress in trading does not come from frequent entries. It comes from selective entries. Professional traders understand that most of the market's movement is noise. Prices fluctuate constantly, but not every fluctuation carries meaning. The skill lies in distinguishing between random movement and genuine opportunity, and that distinction requires patience. Overtrading often appears after a loss. A trader takes a trade that does not work out, and frustration begins to build. Instead of stepping back to evaluate the situation, he quickly looks for another setup. The mind starts thinking about recovering the loss immediately. But that second trade is rarely taken with a clear mind. Emotion is driving the decision. The trader is no longer responding to the chart. He is reacting to the previous loss. The market senses no urgency to cooperate with that mindset. Sometimes the next trade loses as well. Now frustration grows stronger. The trader increases position size or enters trades more aggressively, hoping to regain what was lost. In a short time, several trades may be placed without the careful analysis that normally guides decisions. This is the cycle of overtrading, and it rarely ends well. Another common cause of overtrading is boredom. Markets do not move with equal energy every day. Some sessions are slow and uneventful. Candles are small. Volume is thin. Trends fail to develop. For a disciplined trader, these quiet periods are simply part of the market's rhythm. He observes, studies, and waits for better conditions. But the impatient trader begins to feel restless. He tells himself that there must be something to trade. He zooms into smaller time frames, searching for tiny patterns that might justify entering a position. The chart begins to look busy, but the quality of the signals has not improved. He is simply forcing trades into existence. The problem with this behavior is not just the number of trades. It is the declining quality of those trades. When a trader enters the market repeatedly without strong confirmation, he exposes his capital to unnecessary risk. Small losses accumulate. Commissions add up. Mental energy drains away. Soon the trader finds himself exhausted, wondering how so many trades produced so little progress. A disciplined trader approaches the market differently. He understands that his job is not to trade constantly, but to trade correctly. When the market offers a clear setup, a strong breakout, a clean pullback in a trend, a well-defined support or resistance level, he acts with confidence. But when the market is unclear, he does nothing. That ability to do nothing is surprisingly powerful. Think about it for a moment. Every trade carries risk. Even the best setups fail sometimes. By limiting trades to the most promising opportunities, a trader reduces unnecessary exposure while preserving energy for the moments that matter. Quality replaces quantity, and quality tends to produce better results over time. Overtrading also weakens focus. When a trader is constantly entering and exiting positions, it becomes difficult to analyze the chart objectively. Each trade creates emotional involvement. The mind becomes cluttered with recent outcomes, wins, losses, near misses. This emotional noise makes it harder to recognize the next genuine opportunity. A calmer approach keeps the mind clear. The trader observes how price behaves around key levels. He watches volume expand or contract. He studies how trends develop and how corrections unfold. Because he is not constantly managing multiple impulsive trades, he has the mental space to see the bigger picture. And the bigger picture often reveals opportunities that impulsive traders overlook. The market will always move tomorrow, next week, and next month. There is no shortage of potential trades over a long career. The challenge is not finding something to trade every day. The challenge is waiting for the trades that truly deserve attention. Reading charts is a skill, but controlling reactions to those charts is mastery. Many traders spend years studying technical analysis. They learn about support and resistance, trend lines, moving averages, volume patterns, breakouts, pullbacks. Over time, they become quite good at recognizing structures on the chart. They can look at price action and understand what might be happening beneath the surface. But something curious happens once real money is involved. The same trader who calmly analyzed charts during practice suddenly behaves very differently when a position is open. The knowledge is still there, yet the reaction to price movements begins to change. Small fluctuations start to feel significant. A normal pullback feels threatening. A quick profit feels like something that must be protected immediately. The chart has not changed. The trader's reaction has. Have you ever entered a trade with a clear plan, only to start questioning it the moment price moves slightly against you? The structure you identified on the chart is still intact, but the mind begins imagining worst-case scenarios. You begin watching every candle closely, searching for signs that your idea might be wrong. This is where mastery is tested. Because charts are not static pictures, they are living movements of price, and those movements include noise. Even the strongest trends contain pullbacks. Even the clearest breakouts can pause or retest a level before continuing. These behaviors are normal parts of market structure. Yet many traders react to these normal movements as if something has gone terribly wrong. They exit too early. Then the trade resumes in the original direction without them. Understanding charts tells you what should happen under certain conditions. Controlling your reactions allows you to stay in the trade long enough for those conditions to play out. Without that control, knowledge becomes almost useless. Consider what happens during a strong trend. Price breaks through resistance with force, volume increases, and the structure begins forming higher highs and higher lows. A trader who understands charts recognizes this pattern as a healthy trend.